Hi everyone. My name is Dylan Wolf, and I'm with Windermere Real Estate. I'm here together with Mike Guild of Caliber Home Loans. Welcome, Mike.
Hi, Dylan. How's it going?
Good, good. Thank you for joining me. I wanted to ask you because and record this video because we have seen over the past few weeks that the interest rates are rising, and that has put a little bit of fear in the buyers. And I wanted to see with you how a home buyer could actually combat these higher interest rates.
Yeah, it's a great question, Dylan. Certainly, we have seen a huge change in interest rates recently. There are a couple of ways that people can combat that, and there's a couple of things that we should look at historically that will help them have a better understanding what's going on with interest rates, kind of why, and how to plan accordingly for their home purchase. Would it be okay with you if I shared a little bit of data here?
Yeah.
So I wanted to start real quick with talking about kind of where interest rates are today. So I know in the news for quite a while now, we've been having a lot of press about historically low interest rates. And then, the press changed and people said interest rates are going up and inflation, and there's a lot of stuff going on. So just kind of wanted to unpack some of that. So this right here is the mortgagereports.com. This is a total third party website. It's not related to Caliber Home Loans at all. So if you wanted to get a really good idea, hey, is my interest rate good? How does it compare with kind of what the national averages are? Here's what they are today. So if we look at this report from today, we can see a 30-year mortgage today is looking at about 5.4%. 15 years are at 4.6. One way that you can combat interest rate increases is by going with a shorter term. And you can see it has a big impact on the interest rate. And that's good if interest is the thing that you're most concerned about. But going with a 15-year term versus a 30 means a lot higher payments. So it could have some significant impact on your approvability. What's been going on, what we've seen going on here is, I like this graph here. It's from MBS Highway. And what it's actually showing us is what is going on with mortgage interest rates and why are they increasing? Mortgages are very much like stocks. They're traded on the open market. People invest in mortgages the same way you might invest in Apple, right? And since the beginning of the year, well, prior to the beginning of the year, you can see that things were pretty stable. They were pretty flat. There wasn't a lot of adjustment. And because rates were at historic lows, lots of loan officers fell into always defaulting to suggesting that the best mortgage option is going to be a 30-year fixed rate because that's the lowest interest rate we've ever seen on that product. And so people maybe have forgotten that for many decades, adjustable rate mortgages are an option as well. Adjustable rate mortgages tend to have slightly better interest rates than what you're going to see. They got some bad press back when we had the housing crash back in 07, but adjustable rate mortgages today are very different than we were back then. Prior, adjustable rate mortgages used to have big prepayment penalties. They used to have balloon payments. They had lots of things that made them very difficult to get out of. So if we look at this graph here, what this is showing us is that really since about January, things have escalated towards higher interest rates. People are investing less in mortgages and they're investing more in the very strong stock market we have. To combat that, because people aren't investing, they have to raise interest rates to entice people to invest in mortgages again, right? So interest rates have gone up pretty significantly, but if you look at a 5.4% interest rate and you look at roughly, you can assume that an adjustable rate mortgage is probably going to be about a 1% better option.
Yeah, we can see that with the 10-year.
Yep. So what you can see is that if you have a 5, 7, or 10-year adjustable rate mortgage today, you're going to get a much better interest rate. And it's going to give you time, especially if you're a new home buyer, to really plan accordingly. It's a good way to limit the amount of interest you're paying now and to maintain what you might have been pre-approved for at the end of last year, which your lender might have came back and said, hey, I'm sorry, you don't approve for that anymore because interest rates have gone up. You might want to have a conversation with your lender and say, hey, maybe we should talk about adjustable rate mortgages.
Yeah.
Now, the way an adjustable rate mortgage works is if you're in a 5-year adjustable rate mortgage, you're going to get that discounted interest rate for the first 5 years of your mortgage. That gives you time to keep an eye on the market. The other thing that people should keep in mind too is that there's been a lot of press in the media recently talking about the potential of a recession. If we go into a recession, historically, a recession has always been followed by lower interest rates. So if you can get yourself into a home on a 5-year adjustable rate mortgage, that gives you 5 years to watch the market, to look at what interest rates do, and to come up with a plan for either refinancing or selling and upgrading within that 5-year period. It just helps you afford a little bit more home than you might afford if people are only giving you fixed 30-year options, right?
Right. And also, I think you touched it already a bit, but most people that buy a home for the first time, most of them sell within 5 to 7 years.
Yeah, statistically, most people who purchase their first home either upgrade or side grade or move within the first 5 years. And oftentimes it's within the first 3 years. Because when you're buying your first home, you'll often make concessions either on geography or maybe some features you wanted so that you can get into the home that you can afford. And just like we've seen throughout COVID, people have been seeing their wages increase pretty dramatically over the last couple of years, which sort of helps combat some of what's going on with higher interest rates too,
Yeah.
because people can afford a little bit more than they could, say, 2 years ago.
Yeah. And then, of course, you have the appreciation on the home.
The appreciation on the home. So this is some fascinating data. Wall Street Journal recently published this article. The first time ever in history, people's people as a national average, national median average, made more money from their home appreciation this last year in 2021 than they made from their jobs. And that's pretty impressive. So if you look at this data, the typical US home rose 19.6% in value over the last year. So if you were to ask me, is it a good time to buy? I would say 100% it's a good time to buy, because even if you're paying a slightly higher interest rate than we were 3 months ago, the home is still appreciating at a level that outpasses what you're paying to have a loan on the home. Does that make sense?
Yeah,
Yeah.
definitely. I mean, as far as I can tell, is if there's a 19.6% appreciation and there's a 5.4% interest rate, you're still making 14.2% a year on your house.
On your house, just by owning it.
Yeah.
And that's much better than paying rent for another year and trying to wait for interest rates to come back down, right? When you
Right.
could secure that appreciation gain now. The other thing we had been talking about the other day, which I think is relevant to this conversation, is with potentially a recession coming down the road, that's going to give people an opportunity to refinance out of those, adjustable rate mortgages into better mortgages if they want to do so.
Yeah.
And the other thing is that in a recession, home values do not necessarily go down. The actual economy doesn't set the value of homes. What sets the value of homes is supply and demand. And we
Yeah.
still have a huge demand for housing. If you and your clients have been out there, you've seen pretty much everything that goes on list has multiple offers on it. There's lots of people out there buying, and the way appraisers appraise property values is not based off of inflation or what the market is doing. It's based off of comparable sales. So appraisers will look in a market, usually a pretty small geography, for homes similar to the one you're buying. And they will look at homes that have closed in the last usually 60 to 90 days. And what did those sell for? And that's how you can rest assured that the home that you're buying is appropriate for the price that you're paying for it. And I don't see that changing even if we go into a recession, especially not here in Washington. I mean,
No.
we have a ton of huge tech companies here. People are still making very good salaries. And I think we'll see that appreciation trend and demand continue for the next few years at least.
Yeah, with 1,000 new people coming to this area every week, builders just can't build quick enough to supply all that demand, and that's why not only you but also Matthew Gardner, which is Windermere's chief economist, is also expecting that this trend of home prices increasing will just continue.
I agree. In addition to that, we have a ton of first-time home buyers that are joining the market here, not just relocations, but people that had been historically renters. And as rent continues to increase, they've decided that they kind of want to get into the point where they're purchasing homes and really starting to put that money to work for them. So I
Yeah,
think the demand will be around for a while. And as long as there is demand, um, the housing market might slow a little bit, appreciation might slow a little bit, but we're not going to see values go the other way. We're not going to see home values go way down.
yeah. No, I think overall we're in a good position in a good market, and Mike, thank you for sharing this information. And I think it's indeed important that we look further than just looking at the 30-year interest rates, and especially considering that most people will sell their house in 5 to 7 years anyway. So looking at the adjustable rates is definitely a good way to combat these increases.
Yeah, and I would say for your clients that are suffering from just a little bit of like maybe whiplash with contacting their loan officers and seeing interest rates go up, if they haven't had the conversation, they should talk with their loan officers and say, hey, what about adjustable rate options? What's out there that I can use to help mitigate this rate so that I can still buy the house that I want to buy? Don't lose hope. There's a lot of good positive things going on in the housing market, and there's lots of different mortgage options out there that can help you make it happen.
Yeah. Well, thank you, Mike. How, if they want to talk with you about all of this, how can they reach you?
Yeah, well, I'm available 7 days a week to help people get into homes. They can reach me on my direct line, which is 360-474-7205, or they can email me. My name's right down there in the corner, mike.guild at caliberhomeloans.com.
Yeah, there was a little stutter, so it's mike.guild at caliberhomeloans.com.
That's right. Yeah.
All right, great. So yeah, and if you are looking to buy or to sell, you can always reach out to me, Dylan Wolf. You can reach me at 253-249-1221 or Dylan at thewolfsnest.com. All right,
Take care,
thank you,
Dylan.
Mike.
Thanks for having me.
Bye-bye.